The Federal Reserve today decided not to change interest rates, keeping borrowing costs steady.
Economists say the bigger story is what comes next, including potential rate cuts later in the year. Bradley Blackburn reports.
At the first Fed meeting of the year, there was no relief for Americans who borrow money. Federal Reserve governors voted to keep the benchmark interest rate steady at 3.5% to 3.75%.
We see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals.
The rate is down from over 5% in 2024, but the Fed is holding off on more cuts, pointing to solid economic growth and still elevated inflation. CBS business analyst Jill Schlesinger says policymakers are taking a wait-and-see approach.
I think that the Fed is really stuck right now because they don't have enough data that tips the balance in one direction or the other.
Schlesinger says steady rates can be good news for savers, but not for borrowers.
You look at the average credit card balance interest rate, it's over 19%. Personal loans are still very expensive.
The decision comes with mounting political pressure on the independent central bank. President Trump has publicly pushed for rate cuts, and the Justice Department has opened an investigation into Fed Chair Jerome Powell over a multi-billion-dollar renovation project at the Fed's D.C. headquarters. President Trump also tried to fire Fed Governor Lisa Cook last year, a case that's now before the Supreme Court.
I would say that that case is perhaps the most important legal case in the Fed's 113-year history.
Powell's term as Fed chair ends in May, and the White House is expected to announce a successor soon. The next meeting on interest rates is in March.